Hello, I'm Mike Ditch, and welcome to our presentation, Banking Survey Results and Top Industry Concerns, presented by Allen Gibson Hewlett LC. Before we get started, I'd like to introduce you to our speakers. Our first speaker today is Mark Schmelzle. Mark leads AGH's financial industry team, which is a group of AGH professionals that spends a significant part of their time focused on understanding and serving financial institutions. Mark is a member of the Kansas Bankers Association and has conducted presentations at their conferences. Our second speaker is Brian Johnson. Brian is a technology executive and consultant with more than 30 years of experience. He has extensive expertise in IT risk advisory services and has earned the Certified Information Systems Auditor credential, as well as additional certifications in operations management, systems engineering, and solution development. I'll hand it over to Mark to begin today's presentation.
Good day, everyone, and thank you so much for taking time out of your day to listen to our presentation. We wanted to record it in advance so that you could listen to it on your own time and forward it along to others as you see fit. As our host mentioned, my name is Mark Schmelzle, and I am head of the Financial Services Industry team here at AGH. AGH conducted a banking industry survey in late November 2015 that asked respondents to rate their top areas of concern going into 2016. We gave them different areas to rate on a scale that ranged from unconcerned to very concerned. Respondents included bank executives from large to small banks, and we felt that what they communicated was a representative of what we've been observing and hearing. If you've not already received a copy of the survey results and would like to, just email me at mark.schmelzle@aghlc.com. as appears on the screen. So now let's jump into the survey real quick, and let's look at what those concerns were that were ranked by the bankers out there in the community. We're going to do this in reverse order, so I'm going to start with number 5 on the list. And number 5 on the list was the current expected credit loss model. Bankers out there commonly refer to this as the CECL model, and this is the model that FASB passed in late 2015, ASU 2016-01, and the key elements of this model is the effects of how the allowance calculation will now be derived at many of the financial institutions. So the primary driver of the CECL model was the last downturn in the economy, and this is supposed to allow bankers a way to recognize losses in their loan portfolio much quicker. And so that's what derived FASB to come up with this new model. The effective date for the new CECL model is expected in 2020, but I would not wait until December of 2019 to start looking at the CECL model, because it is a significant change from the current model we have, which is looking at the historical losses only, whereas the CECL model is also taking into account future events that bankers now got to predict when developing this model. So what things you can do to get started is to identify key data points that will be needed and that we'll need to start capturing in order to develop the new model. Need to also develop a process for ongoing maintenance of the data to make sure the data is valid and accurate, and to also start developing the supportable forecast for loan segments that will correlate to losses within your portfolio. So for example, a consumer loan unemployment rate may correlate very well with losses within the consumer loan portfolio. So each portfolio segment will likely need some sort of correlation factor that needs to be tracked and analyzed in order to help develop those losses. So there will be a lot of data mining that goes into this model. We certainly expect a lot more guidance to come out in 2016 as it relates to this model, so stay tuned. Many think that the change that will come about because of adopting this model could increase some allowance calculations upwards of 30 to 50% is what we hear very commonly. And the one thing to keep in mind that initial adoption of CECL, when you do have to take that increase of 30 or 50% of your allowance, that will not run through your income statement, but will be a one-time adjustment to your equity or to your capital accounts. So keep that in mind as you're getting ready to adopt and how that may impact your financial statements or, more importantly, your capital levels at your financial institutions. Number 4 on our list was talent, recruitment, and retention within the community banks. Right now, many community banks have an aging workforce, and the need is greater now more than ever to start to adopt to changing customer demands. And what we're seeing more and more is customers relying more on technology or wanting to move more to technology platforms, whether this is internet banking or the use of cell phones for banking. Consumers more and more are not going to the traditional brick and mortar, so it will cause the need for many community banks to develop new technology platforms and to have talent to be able to deliver those technology platforms as well. Some of the other top needs for talent within the community banks is within internal audit and compliance. Again, banks have had tons of regulation over the last couple of years, and keeping up with the demands that the regulators have is crucial for the success of the bank, and making sure that community banks have that talent to be able to meet the needs of the regulators will be important. And also right now, a lot of banks in 2015 saw nice growth levels within their loan platforms, which I believe will create need for additional lending talent, and then also credit analysis to be able to sort through those new loans and determine which ones are creditworthy and not for the bank. So I think those are two of the bigger needs that we see as we go around talking to banks, and also as reported here in the survey. Another large need for talent recruitment has to do with succession. A lot of banks have ignored succession in the past. A lot of the community banks out there are, primarily family-owned or closely held, and one of the reasons why succession is a big deal is a lot of the kids of these family-owned banks don't want to stay in these communities, and also don't have an interest in banking right now. So succession planning will be a really big deal in making sure there is talent, maybe even outside the family that had ran the bank for a long time, to be able to move the bank forward. And I think one other point that really hurt the community banking or banking in general industry was the financial crisis that we went through 07 through 10, or maybe just now getting out of. And I think that really hurt the appearance of the banking industry, and kind of the perception that younger individuals in school right now, or getting out of school, perceive as a career in banking. It isn't as attractive as it once was. So I think the industry as a whole has some rebuilding to do as far as attracting that type of talent to banking as well. The next issue I touched on a little bit, regulatory issues is always been a top concern of banks, and it keep rising up the level as well. Basel III, BSA, Dodd-Frank, the Volcker rule. I'm sure all you bankers are very familiar with these different acts and rules and regulations that are out there. And so just keeping up with it has been a huge challenge in making sure banks stay in compliance as well. I hear from many bankers that they've seen double-digit increases in spending over the past few years, whether this is personnel expenses or just technology expenses to meet those changing demands, but don't see regulation ending anytime soon. And I think the biggest issue is just what's going to be next in the banking community. I know for years, it seems like there's something new every year, as we mentioned, BSA, Basel III, those type of things. So just paying attention to the horizon of what could be coming down the line within the industry as well, and being able to adapt to that is a real issue. Number 2 on our list was just the overall economic conditions in the U.S. and the global markets for that matter. I mean, a lot of our businesses that we lend to and work with have a lot of international operations, whether it's importing or exporting. So not just U.S. economic conditions, but worldwide. So concerns over China is a big fear I hear from everybody. You know, what will happen with their economy? A lot of U.S. exports go into China. Oil and gas industry is one, you know, even here in Kansas and outside of Kansas, with oil prices being significantly lower than they were several years ago, we're seeing a lot less activity. And that all trickles down through those communities where if there's less exploration going on, there's less people in town, less hotels being used, less steel companies, demand for their types of products as well. So, which is a lot of the customers that community banks here are lending to. So it does have very much a trickle-down effect to all of us. Another big concern in the economic area is with ag. Over the last couple of years, the decrease in the commodity prices is something to keep an eye on. Many farmers, back when the ag prices were very good, leveraged up quite a bit with purchasing new land and new equipment and to expand operations. And now as commodity prices decrease, it hurts the cash flow. So the ag concerns is something big out there right now. And then, you know, what's the next bubble to happen? There's talk whether it's ag, you know, obviously oil and gas and energy is down, but is there something else out there that we haven't seen yet? So paying attention to what that might be. And then the last economic concern is just with interest rates. You know, we've been in a very low interest rate environment over the last couple of years. Interest rates just went up a little bit here at the beginning of the year. Will we see that continue to happen, and how quickly will that happen? So I think there's a lot of things to keep your eye on in 2016 and years yet to come. So it looks like IT cybersecurity remains a top concern among banking executives. We're seeing this at a national level as well. JP Morgan, Bank of America, Citibank, and Wells Fargo are spending $1.5 billion to battle cybercrime in 2016. In response to some compelling statistics, according to Tech Insider, nearly 300 million records were leaked and 1 billion was stolen due to cyber attacks in 2015. Additionally, there are millions of attempts to hack into businesses, including everything from malware to payment fraud schemes. Experts don't believe 2016 will be any better. Plus, financial services firms are 300 times more frequent to be hit by cyber incidents than businesses in other industries. So it's no surprise this came up as the top concern on our survey. Things we expect to see in 2016. Increased attention to cybersecurity in bank exams. Also, increased use of the FFIEC cybersecurity self-assessment tool to assess cybersecurity awareness and controls. Brian will talk more about the self-assessment tool later in this presentation.
Thank you, Mark. At this point, we'll hand it over to Brian Johnson, our Senior Vice President of Technology Services, to talk more about cybersecurity and some things to keep in mind in the upcoming year.
Cybersecurity risk is a really, really important issue. It affects all of us regardless of our industry sector, but it's critically important to the financial services industry, given the nature of your business and the stakeholders that you serve. So, what can you do to better manage your cybersecurity risk? Where do you start? My advice is to change your perspective, to think differently about cybersecurity risk. And the best place to start is, quite frankly, with your leadership. Your board and executive leadership must be consistently aware of, and perhaps more importantly, asking questions about your institution's cybersecurity risk. I really, really like Martin Greenberg's perspective. Mr. Greenberg, as we all know, is the current chairman of the FDIC, and this is what he says about cybersecurity. Cybersecurity is no longer just an issue for the IT department. Instead, it needs to be engaged at the very highest levels of corporate management. Cybersecurity has become an issue of the highest importance not only at the FDIC, but for the FFIEC and its member agencies, as well as the federal government as a whole. In essence, Mr. Greenberg is saying, and Mark and I agree, that cybersecurity risk is business risk. Cybersecurity risk is business risk. And to effectively address that risk, you need commitment and involvement at the top. Now, does that involvement require your leadership to have deep technical expertise? Well, of course not. But they do need to understand the type and the nature of your risks, and they should know what questions to ask. For example, what financial information do you manage? Where is it transmitted, processed, and stored? How critical is it to the reliability of your banking processes and services? How sensitive is it? Is privacy and confidentiality a requirement? What are your key business assets? What information, people, technologies, and facilities are critical to your operations? And are those assets adequately protected? What connections do you have? How are people and other systems connecting to your critical assets? How do those connections expose you to threats and risk? Are you identifying and addressing those risks? If so, how are those risks being evaluated and communicated? Are you prepared to mitigate your risks? Which of those risks are most important? And how do you monitor the effectiveness of your controls? And most importantly, will you know when your risks change? And what about third parties? What risks are introduced each time you engage with a third party and grant them access to your critical assets? Now, this list isn't comprehensive, but I think it is representative of the types of questions that your leadership should be asking. Why? Well, because cybersecurity risk is business risk. Now, I'd like to leave you with one more concept to consider. We can't talk about cybersecurity risk without mentioning again the FFIEC Cybersecurity Assessment tool, or what they call the assessment. Let's face it, regulators are going to be asking for your cybersecurity assessment. So if you haven't started, I would encourage you to do so. Now, is the tool perfect? No, it's not. Will it be easy to complete? Not if you do it right. But I do believe if done properly, the tool can help you better understand your exposure, and more importantly, help you identify gaps in your controls and practices. The assessment was designed to help you better understand two things: your inherent risk profile and your cybersecurity maturity. Your inherent risk profile and your cybersecurity maturity. You'll develop your inherent risk profile by evaluating the type, volume, and complexity of your operations and your unique threats across 5 categories that range from things like technology and connection types to external threats. Then, from that evaluation, you'll be expected to define your overall inherent risk profile. In other words, what risks do you face in your operations before applying relevant controls? The inherent risk profile is represented on the horizontal axis of the chart that we've included on this slide. And as you can see, your inherent risk will fall into one of 5 categories, ranging from least inherent risk to most inherent risk. Then, once you've developed your overall inherent risk profile, you'll be expected to evaluate your risk preparedness in 5 separate domains ranging from cybersecurity management and oversight to cyber incident management and resilience. This will be the more challenging part of the cybersecurity assessment and will likely require participation from both your operations and technology experts. And while you'll only have one inherent risk profile, your cybersecurity maturity will be measured separately for each of the 5 cybersecurity practice domains. Now, the cybersecurity maturity is represented on the vertical axis of this same chart. And as you can see, your cybersecurity maturity will be rated on a progressive scale that starts with baseline and can graduate all the way up to innovative. And as your controls become more sophisticated and reliable, you and your bank will progress through the maturity scale. So what will regulators look for, though? What will the regulators look for when they evaluate your assessment? By design, they'll be looking to see if your cybersecurity maturity is appropriate for your level of inherent risk in each of the 5 domains that you will include in your assessment. For example, if your inherent risk is moderate, they will expect your cybersecurity maturity to be evolving, intermediate, or advanced. So if your risk is moderate, they want you to be somewhere in the evolving, intermediate, or advanced area. If your inherent risk is significant or most, you move right on this chart, and you would then be expected to have a higher level of cybersecurity maturity. On the other hand, if your inherent risk is minimal or least, you move left on the chart, and it would be acceptable for you to have a lower level of cybersecurity maturity. Now, why is this important? Why does this matter? It's important because you need to allocate your cybersecurity dollars wisely. And the best measure we have for allocating those dollars is risk, or your inherent risk level. Between domains, you need to allocate dollars where they're needed most to align your cybersecurity maturity with your inherent risk. You don't want to underspend, but you also don't want to overspend if you have weaknesses in other areas. Now, if you don't have experience with things like maturity assessment models or the assessment itself, this can all seem a little daunting at first, but please know that help's available. Mark and I have included a couple of links on this slide that provide more information on the topic, and please don't hesitate to reach out to Mark or myself if you have questions. And with that, I'll turn it back to Mike so we can wrap up.
Thank you, Mark and Brian, for presenting today. If anyone has questions for either of our speakers, please feel free to get in touch with them via the contact information on the screen. We also hope you'll visit aghlc.com throughout the year to check out all of our helpful business resources, as well as aghuniversity.com to view our current listing of free webinars. Thanks again for listening in, and have a great day.